What's up, everyone? Today, let's talk about how I plan to drop $100,000 into HHIS. Let's go into the reasons why that I might do it, some reasons why I'm maybe a little bit trepidatious about doing it. We'll top it all off, what I'm actually going to do, and we'll sprinkle in what HHIS is all about and the fund that I currently have that I'm replacing it with. So, as always, let's rip. So first, let's try to understand the single stock CoveredCall ETF landscape a little bit. Now, for the longest time, Purpose Investments was the only fund manager in Canada that had single stock ETFs. And I wouldn't say they were the most popular thing in the world. I wouldn't say they were unpopular. They were just kind of chugging along somewhere in, the middle, the Midlands of popularity. And then YieldMax down in the States starts doing their thing with single stock ETFs, popularity of single stock ETFs. With the CoveredCall overlay just explodes. And it was only a matter of time before maybe another fund manager or more fund managers up here in Canada would start getting encroaching on Purpose's territory. And so that's exactly what happened. Basically, we have two companies in Canada that are locked in a contest of hold my beer. If you're not familiar with what this term is, let me learn you something. Imagine you're playing basketball with some friends. You go in for the layup. Your friend says, hold my beer. They take a three-pointer, nail it. You say, hold my beer. And you score, from half court, right? It's just a game of one-upmanship. And I kind of feel like that's what's going on between Harvest and Purpose, right? Purpose had these single stock ETFs for the longest time. Harvest comes along and says, hey, Purpose, hold my beer. And then they start releasing a pile of these single stock ETFs. And they just released a bunch more with the funds that you actually see here, with the most interesting one that, at least for me, I'm interested in, HHIS. I do not care about single stock CoveredCall ETFs. I don't care what the yield is. I care about diversified funds, even from a batch of single stock ETFs. Diversified, that's the name of the game for me. So that's why we're even talking about this here. I'm interested in it. Harvest, they release a pile of stuff, and anyway, so this creates quite the buzz in the income community. Wouldn't you know it, Purpose comes along and says, hold my beer. And they just released, a pile of more single stock ETFs as well. So, I mean, we even got YMAG, right? They're stealing a couple of the ticker symbols. I've noticed both are doing this. They're stealing like YieldMax ticker symbols, which is okay because the YieldMax stuff is on one exchange. These ETFs are on a different exchange, so you can have like the different ticker symbols like Misty and Coiny and Tesla and anyway. And Purpose is doing the exact same thing with YMAG, right? With the Tech Innovators Yield Chart. Well, I don't believe, is that the Meg 7, like the actual Meg 7? Anyway, you're gonna get 7 tech stocks in YMAG. Anyway, so they got a bunch of other single stock ETFs. So now basically the landscape is great for us income investors as we get to see these two duke it out, and who arises out of the rubble that yet remains to be seen. Nonetheless, you should probably understand the competition landscape of what's going on. It's heating up quite a lot. No doubt Harvest is going to have some more funds to come this year. I would say probably expect, they have about 9 right now. I think they're aiming for about 15. I think it's 15, but it might be upwards of 20. So what is it about HHIS that piques my attention? Why would I consider dropping, say, $100,000 in on it in the first place? Well, let's just start off what I had said just a couple minutes prior, which is the fact that I'm interested in diversified funds. Now, there's a lot of diversified funds out there from fund managers I may never invest in. Who knows? Because, I like things that are above a 10% yield. So this one in particular strikes my interest because something I talk about in many of my videos, I like diversified funds where I'm looking for a yield-seeking, growth-leaning approach. I'm constantly looking out for what is the maximum, potential price return along with the top yield that we can get, maybe in equilibrium with one another. And this is where HHIS, above all other diversified funds here in Canada, that has maybe the highest potential. Now, at the time of recording, this fund has not been out that long. There has been no distribution whatsoever. It's a bit of a waiting game at this point and speculation as to what it's going to do. At the moment, that's where I see the potential being. Maybe it's flat out. Maybe it doesn't happen. I see it having that potential. So let's go through some of the highlights of this thing that make it like an interesting fund. You can see that it is, what do we got here? The Harvest Diversified High Income Shares ETF offers a multi-sector portfolio that captures a diverse selection of trending companies that are positioned for strong growth. And I don't think there's any doubt about that. These are probably some of the most volatile stocks out there with, yes, the highest maybe growth long-term potential out there. Some advantages, of course, it's a batch of single stock ETFs. It's diversified exposure to the top trending companies, tax efficient. I want to say Adriano from Passive Income Investing got to interview Michael Kovacs the CEO of Harvest, who I've had the pleasure of meeting, and I think they were saying that if you understand how tax factory summaries work, I believe that Michael was saying that this will probably end up in the ROC category, so the return of capital category, and probably a mix of capital gains. That is some of the most tax efficient stuff out there. You can pick up my CoveredCall ETF All-Star Tracker with the tax tab. Educate yourself on that for yourself. Let's look at the holdings. Basically, it's the equal weight. So for me, I would say that the funds or the stocks in here that are usually kind of would normally be a no-go for me are like MicroStrategies, Coinbase, like the crypto stuff. I tend to stay away from, like Bitcoin ETFs. I typically just stay away from. I like to invest in things that have useful utility. Now, the only times I make exceptions to this rule are if some of it is kind of wedged into a diversified package. For instance, I invest in BMAX, by Brompton Funds. It's a multi-asset, all-in-one CoveredCall ETF that invests in other ETFs. And there is some fixed income in there, some preferred shares of different funds. So normally I don't invest in bonds. That's really my only exposure, but I really like the structure of BMAX. So I don't mind a little bit. Some of the other ones like HYLD and HDIV and others that I've invested in before, usually they all kind of have like a small allocation to bonds, very small, and so I don't mind. That's okay as long as it's not this big overwhelming dominant factor within those ETFs. So in this case, are they the most dominant? They have prominence, but I wouldn't say that these two together are the most dominant. And a little bit of exposure even into something that I might not normally invest in. It's not the end of the world. So I don't mind that from that point of view. Like I said, it's mostly equal weight. You can kind of see there's a little bit of a breakdown here. Now you're gonna get that as the value fluctuations of these stocks as they change. You would see that in your own portfolio if you set targets and you buy to those specific targets. Let's say you use Passive, which I do as well, and right, every so often they kind of go out of balance a little bit. Some drop from your target, some go above your target. It's just based on what the value of them basically are. They're never exactly equal weight because that would mean rebalancing on a fairly regular basis. I'm not sure what their rebalancing schedule looks like, but it might be more traditionally it's about once a quarter. We get some volatile stocks, trendy stocks. I believe the yield that they're aiming for on this is probably in excess or above 20%. It would make it the highest yielding diversified fund here in Canada. For the Americans, I mean, you guys are used to, right, the high yielders. 20% is like on the low end for you income investors. But here in Canada, the fund managers, they're really conscientious about how much yield to give out versus what the potential ramifications might be from a declining NAV. It's possible. So with this fund, this is something we're just going to have to look out for. And we kind of get a little bit of a history with those other single stock ETFs that they provide. But this being the first diversified single stock ETF, kind of hard to tell, right? Harvest has been and has shown a tremendous ability to keep paying out the exact same distributions and add growth to them. They might, I believe they only have one fund where they've cut, which is their energy fund, HPF, I want to say, or HBF. Also important to note that the fee structure of HHIS, it's 0% management fee, but you do pay the management fee through the underlying ETFs. The fund that I would be replacing it with, which is this long time, very familiar staple, which is HYLD.U, which I have in my wife's spousal RSP. We're looking to liquidate that account at the earliest of August of 2026. Regardless of whatever fund is in there, if it stays HYLD.U or if it's HHIS, it would be a short-term hold, which, I mean, for the kind of weight that these funds have in that portfolio, if you to take all my different accounts, this would make up about 40% of everything. So it's no small amount of money in these accounts. Now, we don't have a yield yet because there is no distribution yet to at least try to gauge the forward-looking yield. But again, we're maybe looking at around 20%. I would say that might be on the low end, but 20 to 25%, somewhere in there. Since it's been out, as of the time of recording, I want to say it's maybe been out for 2 weeks. It's around there, and it's already down 8.02%. I'm not rushing into this at the moment. Now, I would say when I got the idea to get into HHIS, I was actually pretty excited, but as always, I think it's a good rule. I use it for myself. This is a classic example of thinking about the potential price returns, the potential yield, the income that can be generated, doing all the different calculations. Wow, my income would jump by whatever it was, $500, or maybe even, I think it was actually more than that. But then I took 24 hours just to cool off, and you know what? I came back to kind of normally how I think about these things, which is just stable. Just look at them in a stable manner. Over the past week, we can see it's actually up 3.46%. I mean, naturally, anytime you concentrate a fund down to its smallest fundamentals, right? 9 stocks versus whatever HYLD has. It's an ETF that invests in other ETFs, which invest in, you could call it 20 stocks with underlying assets in those ETFs. So if that makes sense, there's going to be not as much ability to grow against a fund where it only has 9 underlying stocks. So that potential outperformance could be there. And then, of course, year to date, HYLD.U is a little bit behind, but HHIS has not pulled ahead in the total return category, which I figure it will. I suspect, once again, I do think HIS does have the potential to well outperform HYLD.U, but you're going to be in for one heck of a bumpy ride with this fund. So I would say this: how am I planning to play HHIS currently? I am in no rush to get into this. I think what would be beneficial to me is probably wait for 2 or 3 distributions to come out, and just to see what the trend is like how much does that distribution drop the NAV on those ex-dividend dates, and get a little bit of a feel for this. Now, normally, I would say if this was a diversified another kind of S&P 500 fund, or a stock selection fund that was trying to mimic the S&P 500 or the NASDAQ. Well, there's so many funds that are kind of constructed very similarly, where I wouldn't mind, I wouldn't necessarily really care to jump into those funds fairly quickly. But HHIS, kind of one of a kind here in Canada right now, so I'm playing a little bit of a waiting game on this. I do believe it has a place in my portfolio, whether it's in my wife's spousal account or somewhere else. I've thought about using it, if I don't use it in this sense, maybe using it as a yield booster into a non-registered account that I'll be getting into this year. Maybe have a 10% weighting there, but just to help kind of lift my target yield for that fund, which is 14% roughly. All in all, I think you could use it as a yield booster. Do you go all in on this thing? Maybe in my one account, it looks like I'm going all in, but spread across all my other accounts, it would be the dominant factor. Hold it short term with the potential for maybe a longer hold than, say, almost 2 years. Again, it's simply something that I don't need as soon as I'm able to pull from that spousal or RSP. So the potential for income generation is there, especially for heading into a lower market. That could be a good place where I can reinvest, pick up more units of HHIS. A lot of strong possibilities there. HYLD.U has been just a killer in my portfolio. I've really enjoyed having it. This is what HYLD.U looks like currently in my own portfolio. So my current yield with it is 13.77%. If you were to buy it today, this would be your yield at 11.6%. Of course, it trades in USD. I bought it in August of 2023. So getting into USD back then was certainly a lot cheaper than it is today. My price gain is almost $16,000 Canadian, so that would be another reason why I might want to liquidate HYLD.U, is to take advantage of some of these unrealized gains, start putting them to work in a fund like HHIS. You know, having HYLD.U is certainly a lot more risk averse than HHIS, and that's not a bad thing. But it is just something I'm thinking about. So, and if you've seen my other videos, I've taken steps to eliminate where I've kind of gotten some racked up realized gains and starting to put them to work. As an income investor, that's what my goal is, to try and do that. So right now, my price return on HYLD.U all time is 18.7%. Total return since I bought it in August of 2023 is 42.9%. Killer total return. Again, it's been stellar for me, and it now generates, well, I haven't gotten the distribution yet, but we're expecting just a little under $1,000 in Canadian dollars. You never know, might get a little bit more, especially as that dang Canadian dollar keeps on dropping. Today's the first day of tariffs, so I would suspect my March distributions will go definitely a lot higher if the Canadian dollar keeps sinking. So how are you all planning to, how are you all thinking of playing HHIS for yourselves? Is it going to be a dominant piece in maybe one of your accounts? Is it going to be a sidebar that you're going to use as a yield booster? Please let me know in the comments, because I'm probably going to wait on this one. So getting some extra, context and how you guys are playing it, you never know how that ends up helping me out to make obviously a final decision on that. So I'm very curious, of course, how the community is going to play it. So as always, hit all the buttons of like and subscribe variety. And of course, you can pick up the CoveredCall ETF All-Star Tracker for yourself if you're interested in getting a 1-year membership for it. So head down to the description below for that. I will see you all in the next video.